Is Autoliv's latest move a turning point for the global auto industry? Trump's tariff barrage is rattling automakers from Stockholm to Detroit. Autoliv is pushing costs upstream. Volvo is betting big time on a US shift, and Europe is sprinting to dodge a 30% blow to its exports. Meanwhile, investors are watching with one eye on earnings and the other on Washington's next move. This isn't just a supply chain shakeup, it's an all-out trade battle with massive consequences. Hit that like and subscribe button and stick around as we break down who is absorbing the impact, who is making tough cuts, and what is on the horizon for the global auto industry. Let's begin with Autoliv, the world's largest supplier of airbags and seatbelts, which didn't just weather the tariff storm in Q2 2025, it capitalized on it. Amid rising US tariffs on imports from Mexico and Canada, the Stockholm-headquartered giant strategically passed about 80% of tariff-related costs directly to its customers. Major automakers like Volkswagen, Stellantis, and Toyota. CEO Mikael Bratt was blunt. There's no logic whatsoever why the suppliers or the value chain should absorb this. With a deft hand, Autoliv not only avoided margin erosion, but upgraded its full-year organic sales growth forecast from 2% to 3%. In an environment where tariffs have most suppliers playing defense, Autoliv is leading the charge. The company reported $251 million in adjusted operating profit, up from $221 million a year earlier, and maintained an adjusted operating margin of 9.1%, close to industry-leading. That kind of financial resilience didn't happen in a vacuum. Autoliv continues to expand its reach and innovation pipeline aggressively. Strategic partnerships with Euro Wind Energy for renewable energy and ASTYX for long-range radar tech show it's preparing for the long game. Its collaboration with NIO on next-gen airbags and Great Wall Motor in China highlights its focus on key growth markets. On the safety front, Autoliv's tech saved 37,000 lives and prevented 600,000 injuries in 2024 alone. That's not just PR, it's core business. With 13 R&D centers, 20 test tracks, and operations in 25 countries, the company is not just surviving global headwinds, it's writing the playbook on how to dominate through them. And while many suppliers are caught flat-footed by geopolitical shifts, Autoliv's proactive stance, especially its ability to offload tariff pressures, shows just how dialed in its strategy is. Tariffs were supposed to hurt. For Autoliv, they turned into a catalyst. Next, talk about how Sweden's Volvo car company responded. Volvo Cars is also feeling the heat of Trump's tariff war and responding with a major strategic shift. With US import tariffs on European-made vehicles jumping to 27.5% and a further hike to 30% looming, Volvo has fast-tracked plans to build its flagship XC60 SUV in its US plant by late 2026. This isn't just adaptation, it's about survival. The automaker's Q2 operating profit dropped to 2.9 billion Swedish kroner, $297.83 million US dollars, down sharply from 8 billion Swedish kroner last year. Revenue fell to 93.5 billion Swedish kroner, with a massive 11.4 billion Swedish kroner non-cash impairment charge dragging down margins. Tariff pressure alone shaved off nearly $1 billion in profit. The company's gross margin dropped from 18.2% to 13.5% quarter-over-quarter, a direct hit from tariffs and model delays. Despite the pain, Volvo's leadership remains firm. CEO Håkan Samuelsson insists they will not exit the US market after 70 years of presence. But they are trimming the fat, phasing out sedans and wagons from the US lineup, and focusing on high-volume SUVs like the XC60 to optimize the underused South Carolina plant. Tariffs are pushing Volvo into a leaner, more US-centric strategy. Whether that's a long-term win depends on how fast they execute and how tariffs evolve. But Volvo isn't alone. Car makers worldwide are juggling earnings calls and trade bombs in real time. Globally, automakers are straddling a minefield. On one side, Trump's revived tariff agenda. On the other hand, a murky earnings season with rising competition and shifting demand. Since April, auto stocks bounced back. US car makers surged over 40%, beating the S&P 500. But the rally is fragile. As earnings roll in, investors are cautious. Ford's and GM's profit expectations have plunged by 30% and 18% respectively in recent months. Tesla's estimates fell 47%. partly due to an expiring EV tax credit in September. Meanwhile, Chinese automakers like BYD are flooding markets with lower-cost EVs, squeezing everyone's margins. Europe's outlook is grimmer. Volkswagen's US sales dropped 16% in Q2. Porsche saw global deliveries fall 6%, and BMW and Mercedes both reported declining US and China sales. Volvo's $1.2 billion impairment and a sharp decline in margin added to the turbulence. One theme stands out: suppliers are faring better. Companies like Autoliv and tire makers such as Michelin are proving able to pass on tariff costs. That's a rare bright spot. The real wildcard? Trump's tariff policies are swinging markets and strategies alike. Until there's clarity, auto companies are stuck navigating on instinct and quarterly damage control. What more bad is that Trump's tariff war is not going anywhere, at least for now. With Trump setting an August 1 tariff ultimatum, the European Union is scrambling to avoid disaster. At stake, a potential 30% tariff on EU exports, especially automobiles. That could kneecap European automakers already bleeding from existing US tariffs of 27.5% on vehicles and 25% on auto parts. The EU's counter-strategy? Fourfold. First, negotiate in good faith. Second, prepare reciprocal tariffs, 72 billion euros worth, including measures on steel and aluminium. Third, stay aligned with other affected countries. And fourth, double down on EU industrial competitiveness. A wild card in this game is the so-called takeover effect, short for Trump always chickens out, a nickname born from the pattern of tariff threats that later get watered down. But this time, insiders say Trump is refusing to delay the deadline. To keep talks alive, the EU is reportedly offering tit-for-tat tariff cuts, dropping its 10% tariff on US car imports if the US lowers its tariffs below 20%. But time is short, and stakes are sky-high. The EU-US trade relationship accounts for $1.96 trillion annually, nearly 30% of global trade and 43% of global GDP. Volvo's CEO echoed the sentiment: the EU must act or risk more billion-dollar hits. Tariffs are no longer just tools, they're blunt force weapons reshaping the industry. But the question is, what does the road ahead look like for automakers, suppliers, and global markets? For Autoliv, the outlook is bullish. Its ability to pass on costs and lock in deals for future innovation, like radar tech and renewable energy, makes it a resilient outlier. If margins hold and EV-related demand picks up, Autoliv could near its 12% margin target by next year. Volvo's recovery hinges on speed. Production shifts to South Carolina could insulate it from future tariff shocks, but only if execution is flawless. Cutting 18 billion Swedish kroner, $1.71 billion, in costs and downsizing staff is short-term pain for long-term margin repair. The success of models like the XC60 and EV transition will make or break their US turnaround. Globally, expect the winners to be suppliers and domestic-focused OEMs. Those who can adapt manufacturing footprints and pass along costs like Michelin or Toyota will stay in the green. Meanwhile, US President Donald Trump is demanding a minimum of 15 to 20% tariffs on imports from the European Union if they want a deal. If the EU refuses and tariffs stick, more manufacturing migration to the US is expected. If the EU cuts a deal, European automakers get a second wind. Either way, volatility is the new normal. In the end, here's a sum up on today's video. Autoliv came out swinging, pushing tariff pressure onto automakers while posting record margins. Volvo is shifting production to survive, even as profits take $1 billion hit. The EU is locked in tense talks, racing against Trump's August 1st deadline. This trade standoff isn't just about duties, it's about leverage and positioning. Automakers are caught in the crosshairs and governments are gambling on strategy. Will the EU and the US manage to strike a last-minute deal? Or is the next quarter set to bring even more disruption? Comment your thoughts below. Hit like and subscribe for the latest updates. See you in the next video.